Welcome back, guys. In this video, we'll be talking about the rest of the Greeks. Gamma. Gamma measures the rate of change of delta relative to the underlying asset price. So, the rate at which delta is changing, and delta is at the rate at which the premiums are changing with the relative to the asset price. Gamma measures all of that. I think you are clear, right? Gamma measures the rate of change of delta related to the underlying asset. So the rate of change of delta with relative to the changing underlying asset price is called gamma. It represents the acceleration of delta. High gamma values indicate high sensitivity of delta to price changes. In this graph, I hope you understand. The strike price is 25. So in the case of delta, you can see the delta is somewhere around 1. Okay. Well, so gamma value is around 1. The stock price at the strike price of 25. What will be my delta? My delta will be zero point 0.5, right? It will be somewhere zero point 0.5 because it will be at the money. And when the strike price, changes from, let's say, the strike price remains the same and the stock price changes to 30. So now my delta will become 1 as the strike price will be in the money for a call, right? Uh, So the gamma, see the gamma, how gamma changes. So the gamma was somewhere around 0.23 when the stock price was around 25. But as the stock price gets higher, and the strike price becomes in the money, the delta increases, but the gamma decreases. The gamma is kind of decreasing, and as the delta is increasing, the gamma is decreasing. But when it is in the case of out the money, like when it is so 25 in case of when the stock price was at 20, 25 is out of the money. I'm only talking about the call thing. So the delta is very low because it's out of the money. So you can see the delta value is 0.2, 0.3, 0.4 at this point of time. Okay. And the last video we were discussing about how out of the money, in the money, and at the money ka delta is different. At the money is having zero point 0.5 delta, in the money is having 0.21 delta, and out of the money is having 0 to 0.5 of delta. So you see, when it is out of the money, the gamma, so when it is out of the money and it is slowly becoming in the money, at the money, the gamma is increasing. But when it changes from at the money to in the money, the gamma decreases. I think you understood. And it's all about the sensitivity. The highest sensitivity will be when the delta is at the money. So when you're choosing at the money contracts, so 24,350 in the case of Nifty, when the underlying is 24,357 and the spot price is 24,357, you're choosing strike price of 24,350, they'll be having the peak gamma. Because why am I talking about the peak gamma? Because the volatility, so the sensitivity, the gamma indicates the sensitivity, high sensitivity of delta, and gamma is at, as you can see from the normal distribution graph, is at the peak when it is at the money contract. So one of the variable that affects premium price, now it's over, delta. Another variable that came into existence, one of the Greeks, gamma. Now, how gamma changes when someone moves from out of the money to at the money, the gamma increases. At the money pay, it is peak. When from at the money it goes to in the money, the gamma decreases. Peaks at the money, lower for the in the money, for and out of the money. So both the sides you can see it's lower, and at the money it's at the peak. So high gamma means rapid delta changes, increasing potential risk. So the risk associated with the at the money contract is kind of high because the price of the security and the premiums are changing very rapidly. If the price of the underlying moves into your direction, you make money. But if the price of the underlying doesn't go into your direction, high gamma at the money, okay, will make huge loss for you because as soon as the underlying moves opposite to your direction, the gamma's picture will again change in from at the money to out of the money or in the money. in case of your opposite side, but eventually you are going to lose a lot of money when you are trading at the money contract. Simple. Traders should avoid shorting at the money options due to high gamma. So when you are trying to short, let's say you're trying to do option sellings, right? Option selling is best when you are doing it at out of the money contracts, because the chance of you eating the chances of you eating premium is much more higher, and because uh, if the time of the expiry is much less. If the time of expiry is much more, there's a huge chance that the underlying can move from out the money, from in the money to at the money. You won't be able to predict. But when the time to expiry is very less, let's say in the case of us was 14th August. Okay, that day the Nifty is going to expire, and when you are shorting such things, you should not short at the money contract. Simple. Traders should avoid shorting at the money when due to high gamma. And ITM options have high delta but low gamma. So ITM is something that most of the traders prefer. But when you're doing option selling, you can, to eat more premiums, you can go for in the money options. But there's a probability that you can eat premiums when you're doing option selling with out of the money contracts. I think you don't understand whatever I told, but let's digest it slowly. Uh, 17,700 is the Nifty assume the current strike price, current spot price. And you chose a at the money call of 17,700. So the delta of at the money option is zero point 0.5 and the gamma is 0.0006. So for example, the Nifty moves from 17,700 to 17,500. Okay. So what will be the reduction in points? So 200. So the ATM call, will now will become what? It will become out of the money. And how much points did you actually lose? 200 points. Well, what is the delta? So the option premium should decrease from 275 to 175 if only delta is involved. The new delta at 17,700 will be how much? So new delta at 17,700 will be, that is what we have to calculate. Okay. So change in premium will be 200 points reduction, 200 points from 70,700 to 70,500 will change the premium 100 rupees. And you are doing at the money call, the underlying went opposite to your direction, the premiums, you are going to lose the premiums. So from 275, your new premium will become 175. But how much is the what is the new delta now? So 70,500, the delta was 0.5. What will be the new delta when it moved to 17,700 was the original spot price. What will be the delta when 17,500? What is the case of 70,500? So your new delta will be nothing but 200 rupees premium. Whatever is the change multiplied by the original gamma at the time at the money 0.006. That comes out to be 0.12. When you subtract the zero point 0.5 delta, the earlier zero point 0.5 delta with the new gamma 0.12, the new delta becomes your delta for that option. So now 17,700 call will be now, because the market has moved down, the market is trading at 17,500. So the delta will be less. So now it is out of the money, right? That is what I was trying to tell you from the first time. As soon as you'll enter into out of the money zone, the delta will vary from 0 to 0.5. Earlier it was 0 0.5 because it was at the money. Now the new delta becomes 0.38. So that's how the calculations of the new gamma. There will be a change in gamma. There will be change in delta as well. So the option premium from now will be moving according to this direction. So you imagine all these data points are changing very rapidly for all the different strike prices. And in order to understand what exactly to choose from, you have to whenever you're trading, you have to know delta gamma of all these things. So At 17,500, if you're going for a 17,500 call option, the delta for that particular strike price will be zero point 0.5. And the gamma associated with it will be something. And the gamma will at 17,500 at the money will be highest. That's what it says. I think you understood by this. So gamma versus time. So the gamma decreases as time to expiration decreases. So as you move towards the expiry, the gamma of a contract will decrease. And what is the difference between the gamma and the volatility? It increases with higher volatility. So if you are having India VIX going up, I was telling you about the India VIX, right? If you want to do options, you should look at the VIX. If the VIX is above 40, 15, then you should go for option buying because there's higher volatility. There's a more chance of you making the money in options. So a gamma rise, a volatility rise will make gamma to eventually increase. So it increases with higher volatility. Using gamma for risk estimation, it assesses the risk limits for trading. So, a higher gamma will actually be more riskier. That's why, going for in the money would make much more sense now. Doing trading in the money would make much more sense for now, for me personally, I'm telling. Because, there's not huge risk associated with the high gamma and there is more delta that what I'm more delta I'm getting, less gamma I'm getting. So these are the things that I keep in mind before getting into a trade. So changes in gamma affect delta and option premium. So as you know, there's a change in gamma, it affects the delta as well. So you can see from the calculations before, as the strike price moved, the spot price moved 200 points. First the gamma changed. So and how the gamma changes, then it will affect the delta. That how that now that what will be the delta of the position now that when it has become from at the money to out of the money. I think you understood it. So out of the money, the delta decreased. At the money, the delta was, zero point 0.5. And if it was in the money, maybe the call went, maybe if the call would have went from 17,700 to let's say 18,000 rupees, it would have become in the money and the delta would have increased from zero point 0.5 to let's say 0.8, 0.9. First the gamma would have changed and then it would have affected like the 300 points up, so 300 multiplied by 0.006 will be something, and actually it would add to the like now you have to add the same thing to the delta, 0 0.5 plus the let's say 0.19, so it will become 0.69 or 0.7. That'll be the new delta. That's how things changes in gamma. Let's talk about theta. Theta measures the rate at which an option's value decreases due to the passage of time. The most important thing. Why I was telling you that options is a depreciating asset because as the time is passing by, you're actually losing it. So it reflects the day you're losing your money. It reflects the daily decline in the premium of an option as expiration approaches. So a contract which is going to expire on let's say 14th August. As an option buyer, so there's a difference. As an option buyer, you are paying the premium, and the the premium is going to decrease. So it'll be negative for only those who are doing option buying. In the let's look at the other side. In case of option selling, you're getting the premium. So if the premium decreases, you make money because you are doing option selling. A decrease in premium will make you money. So as time passes by, it's bad for option buyer, it's good for option seller. So to eat more premiums, option sellers would try to take the contracts which is like say one from the expiration is 1 month from now because the amount of premium they can eat will be much more higher. You understand? You understood? Like the 400, 500 rupees premium we were seeing in the last video, many of the option sellers will actually try to eat all those premiums, buying all that option, whatever option buying is trying to throw the premium, they'll try to catch all the premium. So the other screen, whatever I was talking about, that if you are doing transaction, it will take in like seconds. But how there is someone who there is so much liquidity in the markets that at any point of time at market price, your orders will be hitting like in milliseconds, because there's always a buyer. There's always a buyer for a seller. There's always a seller for a buyer. So theta is also known as the time decay of an option. uh, Theta is a negative, leading to daily reduction in the options value. The longer you hold, the more value you lose as expiry nears. Even if it is going into your direction, you're going to lose money. Theta is positive for option sellers, benefiting from the daily erosion in options value. So as the time will pass by, the 14th August expiry, as it will become nearer and nearer, uh, option sellers are going to make money, because every day I'll be losing some amount of my premium, because there's a time decay associated with options. Seller profits as the time decays accelerates closer to expiry. Premium decreases slowly with minimal impact from time decay. So early in the series, so premium decreases slowly with minimal. So when you are, when the time to expiry is far, the premium decreases slowly, and it will be minimal impact from the time decay, but slowly the option sellers, you just understand how option sellers make more money than option buyers, because they're getting more benefit even if the market remains the same, or the market goes into their direction, they make money. But for an option buyer, if the markets remain the same, you lose money. If the markets don't go into direction, you lose money. You only make money when the markets are going to your direction. Even though, yeah, the market is going into your direction, you will lose money because there is a time decay associated with the option buying. Simple. The rate of time decay accelerates, causing the premium to drop faster. But you personally doing options from so long, you would care about time decay, because you want to get, because if you have the right kind of mindset and that you want to make money out of options, this is the cost that is associated with it. So you don't have to worry about the small theta decay at least. But you should know that on the day of expiry, the options, the at the money options, or out of the money options are going to become zero. uh, we'll do expiry trading, in live trading sessions, and there I'll teach you that how exactly the option price, the option premium becomes zero at different strike prices, and where it doesn't become zero, and why time decay is the only component that is causing, because the variables will be super high when the time to expiry will be much less, so the variables affecting the theta decay will be super high when there's a less time to expiry. So you can see the option premiums as the days remaining to expiry becomes closer and closer. It tends to zero. I told you, right. So the option premium at 350, it'll slowly be down, down, down. If the move is into your direction, the movements will be up. But slowly, eventually, if the let's say the markets are consolidating and the markets don't move into any direction, the slowly it's going to eat all of your premiums. Factors affecting theta. At the money options have the highest theta. So again, at the money contracts are, at the money contracts is having like most amount of gamma. At the money contract is having zero point 0.5 of delta. It's not having the most delta, but because in the money is having the most delta. But at the money options are having highest theta. So the expiry so when the expiry is very nearby, you should not go for at the money contracts, because they are going to expire almost worthless. You should definitely go for in the money, because there's a surety that it's not going to go zero. And in the money and out of the money options have lower theta. But out of the money options, usually expires zero at zero price when the move isn't not into your direction. So in the money and out of the money options have lower theta, and at the money is having highest theta. Theta increases as the option approaches to its expiration date. So I told you, as the time to expiry becomes less and less, theta is much more, and there's a possibility that you are going to lose a lot of money when you're doing a trading, when you're trading at the time when the time to expiry is very less. For example, 12th August, 13th August, when you're trading onto these dates, the volatility can decrease the theta, but the time to expiry will make it much worse because you are going to lose a lot of premium. So never short in the money and at the money in expectations of options expiring worthless. So, even though in the money, even though at the money is option is having the highest theta, right? You can't expect so and theta decreases as the time passes by. You can't actually short these at the money contracts just hoping that you'll eat all the premiums because if the move goes into the opposite direction and you're doing option selling, you are going to lose a lot of premium. You are going to lose a lot of margins because the premiums will be going totally opposite direction. So there's a rule: never short ITM and ATM contracts. Matlab, there's a possibility that's why I was telling that option sellers makes the most amount of money, shorting out of the money contracts and which the time to expiry is far. This is, how we sums up theta. Theta increases as the option approaches to its expiration date. Higher volatility can decrease theta as the option's time value increases. So if there is higher VIX, so higher VIX will result in higher gamma, and you know and higher gamma will make your contract either in the money or out of the money. So if it becomes in the money, then your this delta will actually make you more money. So theta will not be having that much power to decrease the premium. That's, I think, it will be too much complicated, but just understand this term. Ki if the time to expiry is very nearby, you are, as an option buyer, you're going to lose money. As an option seller, you're going to make money. But you don't have to short in the money and at the money contract. You have to only, there's a possibility that you make more money when you're shorting out of the money contracts. Let's talk about the last Greek, Vega. Vega measures how much an option price changes with a 1% change in volatility. Theta is very, very much important. Time decay, you should be knowing this concept. Depreciation is another way of saying it in the terms of business, but depreciation is for the assets. So this is also one kind of assets because you're actually doing a lot of buying and selling transactions. So time decay is something that you should be very much aware of when you're doing options. Vega measures how much an option price changes with a 1% change in volatility. So if the change in volatility is much higher, the you know how what accounts to this volatility. So if the price of the underlying moves 3% up, so what will be the percentage my options by option premium? How much percentage my option premium will rise? That depends on Vega. It reflects the option sensitivity to market volatility. Vega is always positive, meaning both calls and puts increase in value with rising volatility. What it means? Vega is always a positive term. Okay. There's no negative associated with a put or a call. It increases in value with rising volatility. And as the VIX will become, 16, 17, 18, as in the COVID times, it became 80. So, you know, the Vega would be much more higher. And even if the trade is not going into your direction, actually, you'll make money because, eventually the India VIX will increase, the volatility will increase, the Vega will increase, and so your option premium will. So actually, there was a time then where I was doing trading and market was moving opposite to my direction, moving opposite to my direction, and I was making money. I was like, how? So the volatility was increasing, and because of that, because of the Vega, my option premiums were increasing. Simply, be it CP both. So longer expiration increases Vega due to higher uncertainty. So when there's a you understood. So when the time to expiry is, let's say I'm trying to uh, buy a call option for this month for Nifty. So there's a possibility, Vega will increase due to higher uncertainty. I don't know when with the market what will happen 1 month from now. There is an expectation that okay from this time, let's see, my expectations are the market is going to go down, but as the Vega will increase due to because Because there's a more uncertainty what will happen in the larger time frame, the Vega will increase. Moneyness. At the money options have the highest Vega, being most responsive to volatility changes. So at the money option is having the highest gamma, and it is having the highest. What we learned before this, delta, gamma, theta. So at the money options having the most theta, is having the most gamma, is having the most Vega. So because it's very responsive to, as the volatility increases, the at the money contracts premiums will go up, shoot up. As the volatility will decrease, the at the money options will go down. Vega increases with the expected volatility, but it declines when volatility is already high. So, when the VIX is super high, there's a chances of Vega decreases because the volatility is already very high. From from high, something will go down. From low, it'll go up. So, Vega increases with X. So, if you think that the volatility is very low now, there's a chances of you and the volatility is going to increase. There's a chances of you making money at that time because eventually the volatility is going to increase and so will your option premium. Let's understand from the chart. So much to digest, but yeah, we'll try to do it. Option seller. When the volatility is increasing and the volatility has not increased, so there's a chances of a person doing option selling makes money because let's assume the volatility is not there in the market. That time the sellers will come into the market and they will try to let's say try to predict the markets are going to be more volatile and there will be so much premium that I'm going to eat. So at that time they will be making their positions. Option buyer on the other hand, when the volatility is kind of decreasing, so if something is decreasing, then the option buyer will try to make positions because his expectations will be, okay, boss, now the volatility is going to increase and I'm going to make money. I think when the volatility is increasing, the chances of you as an option seller making money is high. When the volatility is decreasing, the chances of you making money from option buying is high. So I think from the Vega example, you are very clear to this. High Vega means significant price changes with volatility shifts. So you at the money contract is having the highest Vega, means if the market goes into a direction, there's a possibility of you making a lot of money, but in the money contracts will make more money because there's having more delta as well. So but the gamma, Vega, and the theta will not be in the favor of at the money contract, but delta, as they're having weightage. They are not equi-weighted. All these Greeks are not equi-weighted when there's a thing of deciding premium prices, and they are weighted disproportionately. It's not proportional to all this. So there's a chances at what price the premiums are going to increase because of delta, because of Vega, because of gamma, because of theta. It's not the same. Vega risk is critical, especially in volatile markets for long-term positions. So when there's a risk of that the markets are having very much volatile, so there's a risk management strategy. Key, in volatile markets for long-term positions, very risky. So you should be all like investing when let's say the Vega is kind of low, when the market volatility is kind of low, because the chances of your investments, making a lot of money or losing a lot of money will be much less. Use Vega to gauge the potential impact of your volatility on your trades. So you can make a specific strategy based on all these specific things. So you can use Vega to gauge the potential impact. You can study the Vega. What is the Vega at different at the money, out of the money, and you can make a strategy in order to trade in volatile markets. So when to do option selling, when to do option buying, in case when Vega is low, when Vega is high, when Vega is low, like that. What are the key takeaways from the last lecture and this lecture? ITM, ATM, OTM options determine the intrinsic and extrinsic value, guiding trade decisions based on market conditions. So most of the things works opposite for at the money, and you can actually go and trade in the money options, like what my advice would be. But when you're doing option selling and you're trying to short when the expiry is very nearby, avoid shorting in the money and at the money options, because the different Greeks will be not in your favor, and the ones where you can make the most amount of money will be out of the money contracts. Delta measures the sensitivity of an options price to the underlying asset price, with ITM options having the highest delta. So, the trades will be much more into your favor if you are trading into ITM options. Gamma represents the rate of change in delta peaking with ATM options. So gamma is peak when, sorry, and that where the gamma is peak when it is time for ATM options, the gamma will be peak, and it is very less when it is compared to out of the money and in the money, indicating higher risk due to rapid delta shift. So if the markets move into a specific direction because of ATM options having the highest gamma, the premiums of the chances of you making a lot of money and losing a lot of money is very quick. Reflects the time decay. So there's a risk associated. There's a higher risk associated with it. Theta. It reflects the time decay of an options value, with the most significant decay occurring at expiration approaches, especially for ATM options. So, you understood that if the time to expiry is very nearby, there's a huge chance that you losing money when it comes to theta. So, you should if you don't want to if you want to avoid that risk of losing theta decay, you can go and trade into those options which are having expiry very far, so you won't lose a lot of premium. Vega. It indicates how much an option price will change with 1% change in volatility. So it's totally specific to the volatility. Theta is specific to the time. Gamma is specific to the rate of change in delta. Delta is specific to the in the money, at the money, out of the money things when we are selecting the strike prices. So Vega with the highest Vega for ATM options, again Vega, so the volatility is much higher when you're choosing at the money options. So at the money options are not actually bad, to be honest. At the money options and then the money options are good instruments to trade into. And out of the money options are kind of riskier, because there's a chances of you making less money even if the trade goes into your direction, even if the trade goes into your direction. A solid understanding of moneyness of an option Greeks is essential for managing risk and making informed trading decisions in options market. And thank you so much for watching, and I'll see you in the next lecture. Till then, see you. Goodbye.